So, you own some Bitcoin. High five. But let's be honest, for most people, that Bitcoin is making a huge mistake. It's just sitting there. It's in a wallet, collecting digital dust, while the dollar quietly loses value every single day. You believe in Bitcoin, you've held on through the insane volatility, but is this it? Just waiting around for the price to go up? What if you could put that Bitcoin to work? What if it could be generating a real income for you, month after month, without you having to sell a single Satoshi? In this video, I'm going to show you the top 3 ways to earn passive income with your Bitcoin that most people have never even heard of. Stick around, because this is your guide to turning a lazy asset into an income-generating machine. Before we get into the how, let's have a quick chat about the why. You've probably heard that famous quote, often credited to Einstein, that compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, well, he pays it. In the old world of finance, that meant stashing your cash in a savings account, or buying dividend stocks. Your money makes money, and then that money starts making its own money. It's the most powerful force for building wealth, period. For a long time, Bitcoiners were left out of this game. The only advice was, HODL, hold on for dear life, and pray. But the world around Bitcoin has grown up. Now, you can apply that same incredible power of compounding to your BTC. Instead of just hoping for the price to moon, you can earn a consistent yield. An income that pays you for holding the asset you already believe in. This is how you go from being a passive holder to an active investor in your own future. But, and I need to be crystal clear about this, I am not a financial advisor. This video is for educational purposes only, and is absolutely not financial advice. The crypto world is risky. These strategies are powerful, but they are not free money. Always do your own research, understand the risks, and never ever invest more than you're willing to lose. My goal is to show you what's possible, not tell you where to put your money. Okay, with that important stuff out of the way, let's get to method number 1. Alright, the first and most straightforward way to earn passive income on your Bitcoin is through centralized lending platforms. Think of these as high-yield savings accounts, but for your crypto. The idea is simple. You deposit your Bitcoin onto a platform, like Nexo or uHodler, and they lend it out to others, like institutions or traders. In return for you providing the Bitcoin, the platform pays you interest. This is, by far, the easiest method on the list for beginners. You don't need to know anything about smart contracts or decentralized finance. If you can use a normal online banking app, you can use one of these. You create an account, do the security check-in, deposit your Bitcoin, and you start earning interest almost right away. Usually you get paid in Bitcoin, so you're stacking more sats without lifting a finger, which is perfect if you're in it for the long haul. Now, the interest rates aren't the wild numbers you might have seen a few years back, but compared to the fraction of a percent you'd get from a traditional bank, they're still attractive. In 2025, you can expect to see rates anywhere from 1% to 4% APY on Bitcoin from reputable platforms. Some, like Nexo, might offer a higher rate up to 7% if you meet certain conditions, like locking up your funds or holding their own token. Of course, this brings us to the big, flashing, neon sign risk. Not your keys, not your crypto. When you send your Bitcoin to one of these platforms, you are giving up custody. You're trusting them to keep it safe. And this is not a small thing. The crypto graveyard is filled with the ghosts of failed lenders like Celsius and BlockFi. Back in 2022, they took user funds, made incredibly risky bets. And when the market crashed, they froze withdrawals, losing billions of dollars for their customers. The founder of Celsius was even arrested for allegedly defrauding investors. So how do you avoid that fate? You have to do your homework like your money depends on it, because it does. Look for platforms that are transparent and regulated. Do they publish third-party audited proof of reserves to show they actually hold the assets? Are they insured? How long have they been around without any major issues? A company like Ledin is often mentioned for being more conservative with its lending. Scrutinize how they make their money. If a platform is promising you an 18% yield on Bitcoin, that's a massive red flag. A more modest 3% or 4% yield that comes from fully collateralized lending is a much more believable and sustainable business model. Also, keep in mind that if you're in the US, regulatory changes have made some platforms restrict or stop offering these interest products, so your options might be different depending on where you live. Centralized lending is a great starting point, but you have to go in with your eyes wide open, knowing you're trading the total security of holding your own keys for the convenience of earning a yield. Ready to level up? Our second strategy is more advanced but lets you generate income while still holding onto your Bitcoin. This is the world of Bitcoin-backed loans. It sounds complex, but let's break it down. Instead of lending out your Bitcoin, you use it as collateral to borrow stablecoins, like USDC. Then, you take those stablecoins and lend them out to earn an even higher interest rate. Here's how it works, step by step. First, you find a reputable platform offering crypto-backed loans, like Aave, Ledn, or Unchained Capital. You deposit your Bitcoin into a secure collateral account. The platform lets you borrow a percentage of your Bitcoin's value. This is called the loan-to-value, or LTV. For example, with a 25% LTV, if you put up $20,000 worth of Bitcoin, you could borrow $5,000 in USDC. The interest rate on this loan is usually pretty low, sometimes just a few percent. Now for the clever part. You take that $5,000 in USDC you just borrowed and put it into a high-yield protocol. In 2025, it's realistic to find platforms offering 3% to 6% APY on stablecoins. So, let's say you're borrowing at 2% interest but lending out the stablecoins at 5%. That 3% difference? That's your profit. It's passive income you created, all backed by the Bitcoin you were planning to hold anyway. The biggest advantage here is that you never sell your Bitcoin. You keep your position and benefit from any price increase. If Bitcoin's price doubles, your collateral is worth twice as much, but your loan is still the same size. Plus, in many countries, taking a loan isn't a taxable event, unlike selling, which could trigger capital gains taxes. But, and this is a very big but, this strategy introduces a serious new danger: liquidation risk. Your Bitcoin collateral is volatile. If the price of Bitcoin suddenly crashes, your LTV ratio will shoot up. If it crosses a certain line, say 80%, the platform will automatically sell your Bitcoin to pay back the loan. This is a liquidation, or a margin call. Let's go back to our example. You put up $20,000 in BTC and borrowed $5,000. Your LTV is a safe 25%. But if Bitcoin's price gets cut in half, your collateral is now only worth $10,000. Your $5,000 loan is now a 50% LTV. If the liquidation threshold is 80%, you're still safe. But you can see how a deeper crash could put you in the danger zone. The platform will send you a warning, asking you to either add more Bitcoin as collateral, or pay back some of the loan. If you don't act fast enough, they'll sell your Bitcoin, and you'll lock in a permanent loss. The key is to be conservative. Don't borrow the maximum amount. A low LTV of 25% or 30% gives you a huge cushion against market swings. You have to actively watch your position and have a plan for a downturn. This isn't a set it and forget it strategy. It requires active risk management. But if you're willing to do that, it's a powerful way to make your Bitcoin productive, while still holding on for its long-term growth. Our third method is the newest on the block, and it's perfect if you'd rather stick to the traditional financial system. This is all about earning passive income through Bitcoin ETFs and other regulated products that you can access from a standard brokerage account. After the landmark approval of spot Bitcoin ETFs in 2024, a whole new world of tools has opened up for investors. Now, just buying a Bitcoin ETF like BlackRock's IBIT or Fidelity's FBTC is about price exposure. It doesn't pay you an income. The income comes from specialized ETFs that use a strategy to generate yield. The most common of these is the covered call strategy. Here's a simple way to think about it. Imagine a fund that owns a ton of Bitcoin. It then sells call options against those holdings. A call option is like a ticket that gives someone the right, but not the obligation, to buy Bitcoin at a set price in the future. For selling this ticket, the fund gets paid a fee, called a premium. The fund collects all these fees from selling options, and then passes that cash on to shareholders like you, usually as a monthly dividend. The big win here is regulation and ease of use. These are products trading on major stock exchanges like the Nasdaq. You can buy them in your normal brokerage or even a retirement account. No need to worry about crypto exchanges, digital wallets, or platform hacks. For many people, that peace of mind is priceless. However, there is a major trade-off. The very strategy that creates the income also limits your potential profit. If Bitcoin goes on an absolute tear and skyrockets past the options price, your gains are capped. The fund has essentially traded away the chance for explosive growth in exchange for smaller, more consistent income from those option fees. Also, these yields aren't guaranteed. They fluctuate with market volatility. More chaos usually means higher premiums. And the skill of the fund's manager. While some of these ETFs can have high distribution rates, yields in the mid-single digits are a more typical expectation, with double-digit yields being the exception, not the rule. And don't forget, these products have management fees, called expense ratios, that will nibble away at your returns. So there you have it, the top 3 ways to make your Bitcoin earn you passive income in 2025. Let's recap. For the beginner who wants a simple hands-off approach and is okay with custody risk, centralized lending is a great place to start. For the intermediate user who wants to keep their Bitcoin, generate a higher yield, and is ready to manage liquidation risk, Bitcoin-backed loans are an incredibly powerful tool. And for the investor who prefers the comfort of a traditional brokerage account, income-generating Bitcoin ETFs offer an easy, regulated path, even if it means capping your upside. The biggest takeaway is this: your Bitcoin no longer has to be a lazy asset. The days of just hodl are over. You now have real options to make your Bitcoin work for you and turn it into a productive part of your portfolio that generates a reliable income. Which of these methods sounds most interesting to you? Are you already using one? Let me know down in the comments. I read every single one. If you found this guide helpful and it opened your eyes to what's possible, do me a favor and hit that like button and subscribe for more deep dives on building wealth with crypto. Thanks for watching, and I'll see you in the next one.